All right, so I'm just going to start off my answer to the part B here. First, just doing some of my workings, calculating those few ratios that I'll need, and then I might do the actual body of part B in a separate video. So there's 40 mark going for the part B. So like overall, there's 100 marks for this question. I think the easiest way to remember the timing is half the marks and then knock 5 minutes off. So 100 marks, divide by 2 is 50, knock 5 off is 45 minutes as an absolute maximum for this question. Okay, so if you follow that timing, it leaves you on exactly 3 hours for the full paper, which is how much time you have. So it doesn't leave you time for kind of reviewing at the end or reading and choosing questions at the start. So that is, as I said, an absolute maximum for each question, and you should be looking to get one or two of them done a little bit quicker. This part A at 50 marks, like half that is 25 minutes and knock a couple of minutes off. That's one where I think you should be looking to make up a little bit of time. Okay, you could spend a little bit of it here, but what I would just warn you about on the part B is it can be a little bit of a time sink for people. You want to kind of hit the headings you want to hit with a few bullet points in each one, comment on your trends, any kind of benchmark figures, a couple of kind of general comments or statements that we make under each heading each year. But try to be as disciplined as possible and keep maybe as close to about 20 minutes for this part B as you can. That way the time saved here can be used to do your review at the end, or just for that couple of minutes at the start for choosing questions. Now, in terms of choosing questions on the accounting exam, it's not the you don't need to, I suppose, read the questions too in depth to decide which one you want to do. Like if a service firm question comes up, it will be like all the other service firm questions that have come up in the past. You'll know if you're strong on it. You'll know if you want to do it or not. You don't really need to kind of read in, oh, what type of question is this? Is this a trickier one than normal or anything like that? You kind of once you see them generally which ones that you're going to do. But anyway, on to the part B, and the first thing I want to do is just work out the ratios that I will need for my part B. So your guide is the ratios I have for last year. So this is all about comparing trends. What were the numbers last year? What are they this year? Are they going up? Are they going down? Are the, in this case, debenture holders going to be happy or unhappy with that? Okay. So last year I was given earnings per share of 20 cents. I figured that out in part 3 here. So as part of figuring out my price earnings ratio, I needed to work out my earnings per share. It's 18.86 cents. My dividend per ordinary share, I needed to figure out as part of dividend yield. So I have that. Interest cover of 6.3 times, that was part 5. I have that worked out already. Quick ratio of 1.3. Very rarely, I don't think it's been asked for a very long time, or if ever, on the part A. So quick ratio, or the acid test ratio, I'll need to figure that out for part B. So let's work that out. So your quick ratio, or your acid test ratio, is your current assets less your closing stock to current liabilities. Okay, so we are taking closing stock away because closing stock is slower to be converted into cash. So you have to sell it first, and then you're usually selling things on credit, so you'll be waiting for the debtor then to actually pay you. So this is all about how much do I have to pay my short-term debts. Okay, so your current ratio is just current assets to current liabilities, but this quick ratio strips out the closing stock and gives you kind of a how much money do you have if all your short-term debts were called in. Do you have the cash or near cash to pay it? So current assets in this question are 160,000. take away your closing stock. Sometimes closing stock will be given brackets after current assets, or sometimes it's up here in the profit and loss. So it's 90,000 up here. So take away 90,000. And that is to current liabilities. And they've just given me, there's no others apart from the trade creditors there, so just 80,000. So 160 take away 90 is 70,000 euro. To 80,000 euro. And we always give this as a ratio to 1. Okay, so the current liabilities is always to 1. So whatever this is divided into the other side. So 70,000 divided by 80,000. And that is 0.875. It says 2 decimal places, so 0.88. Okay, so that's not a good sign. We want that to be at least 1 to 1, so we'll comment on that when we get to the liquidity section later. Now, what else am I given? I am given market price of an ordinary share, which I'm given for this year. Return on capital employed, I've worked out in my part A. Gearing then, yeah, so gearing, again, another one I think is mainly worked out for this part B rather than asked for in the part A. So the gearing ratio that we're going to use, a gearing percentage we're going to use, is all of, it's basically the percentage of your capital employed that is external debt. So your capital employed, the money invested in the business, is 930,000. What percentage of that is external to the business? So of the 4 items here making up 930, what's external? Well, the debentures and the preference shares. So it's the 2 with the percentages attached. Okay, so they're to do with people aside from the ordinary shareholders of the company. So the ordinary shareholders, these people here, the people who own these shares, the profit and loss balance also belongs to them. Okay, and they're the people who actually own this business. Okay, so the owners of the business are the ordinary shareholders. As I said, the profit and loss balance is due to them as well. So it's the other people in here, your debenture holders and your preference shares. Okay, so gearing is kind of long-term loans, so loans down capital employed, plus debentures, plus preference shareholders. So it's all the external capital down here, all the external debt over capital employed. So what do we have here? And then we're going to, you see it's given as a percentage here, so we're going to multiply it by 100. Okay. You can sometimes give it as a ratio, but it's always given as a percentage in the exam question. So loans and debtors and preference shares. So debentures are 300 and preference shares are 200. So 300,000 plus 200,000 over capital employed, so over 930. And then multiply by 100 because I want to give it as a percentage. And what's that equal to? So 500 divided by 930 multiplied by 100 is 53.76%. Okay, so that is my gearing. So as I said, there is another gearing ratio called the debt to equity ratio, which they give in your textbook. When they say gearing in the exam, just based on the numbers it is and looking back at all the exam questions, it's this gearing ratio that they're looking for. It's this gearing percentage is the one that they're always using on the accounting questions in question 5. the marking schemes will sometimes kind of mention debt to equity in case that's the one people use. I would say ignore that and don't use it. Dividend cover then, no, I haven't done that. Dividend yield down here, I've already worked out as part of my part A, so dividend cover is the last one that I need to work out. So, dividend cover is equal to, so it's your net profit after tax and preference dividend. So I've never seen tax in the question, so net profit less your preference dividend over the ordinary dividend. So your net profit is here, 82,000. So the preference dividend has to be paid every year. So I'm going to take that away. And then the money that's left over after you pay the preference dividend, that's how much you have left over to pay ordinary dividends. So it's how much, that profit you have to pay ordinary dividends out of, how much does that cover the dividend that you're actually paying? Okay, so net profit less preference dividend, 82,000. Preference dividend 8% to 200 is 16,000. We've already worked that out, 82, but yeah, you'll have that in one of the other ratios. But net profit less preference dividend is going to be, as I said, 82,000. Take away 8% of 200,000, so take away 16,000. And that's over the ordinary dividend. The ordinary dividend is this 45, take away the preference dividend. So 45, take away 16, that's 29,000 of that is an ordinary dividend. So of this 45, 16 preference, 29 ordinary. We worked that out earlier as well. So 82,000, take away 16,000 and divide by 29,000. And that is 2.275, so 2.28. And the cover ones are given in times. So just like interest cover was given in times, dividend cover is given in times, so 2.28. And that is it for my calculations. Okay, so I would say, yeah, that's kind of normal. 3 or 4 is normally what you have to calculate for the part B. The rest of them you've usually calculated for your part A. So I will do then the kind of bulk, the body of the part B in a separate video.